The financial world is constantly evolving. With each passing year, new challenges and opportunities arise, prompting the need for continuous adaptation and innovation within the industry. New regulations and accounting standards emerge to address evolving risks and enhance transparency. These changes are designed to protect investors, ensure the stability of financial institutions, and maintain the overall health of the economy. One such significant development is the current expected credit loss, or CECL, standard. Introduced by the Financial Accounting Standards Board, FASB, CECL represents a major shift in the way financial institutions manage and report credit losses. CECL represents a fundamental shift in how financial institutions account for credit losses. Unlike previous models, CECL requires a more comprehensive and forward-looking approach, taking into account a broader range of factors that could impact credit risk. Before CECL, banks and other lenders used an incurred loss model. This model was based on the recognition of losses only when they were deemed probable, often resulting in a lag between the occurrence of a loss event and its recognition in financial statements. This model recognized losses only when they were probable. As a result, financial institutions often found themselves unprepared for sudden economic downturns or unexpected credit events. However, the 2008 financial crisis highlighted the limitations of this approach. The delayed recognition of credit losses contributed to the severity of the crisis, as financial institutions were unable to accurately assess and respond to the growing risks in their loan portfolios. It often resulted in delayed recognition of credit losses, masking the true health of financial institutions. This lack of transparency undermined investor confidence and exacerbated the financial instability during the crisis. CECL aims to address this issue by requiring financial institutions to estimate and recognize expected credit losses over the lifetime of a loan or financial instrument. This approach leverages advanced predictive analytics and a deeper understanding of credit risk factors. This forward-looking approach promotes earlier recognition of potential losses, enhancing financial stability and stakeholder confidence. By anticipating and preparing for potential credit losses, financial institutions can better manage their risk exposure and maintain stronger balance sheets. In essence, CECL is about being proactive rather than reactive. It encourages financial institutions to look ahead, assess potential risks, and make more informed decisions regarding lending and provisioning. This proactive stance not only benefits the institutions themselves, but also contributes to the overall stability of the financial system. It encourages financial institutions to look ahead, assess potential risks, and make more informed decisions regarding lending and provisioning. By adopting CECL, financial institutions are better equipped to navigate the complexities of the modern financial landscape, ensuring they remain resilient and capable of supporting economic growth. At the heart of CECL lies the concept of forward-looking estimates. Unlike the previous incurred loss model, which relied on past events, CECL compels institutions to incorporate future economic conditions and their potential impact on credit losses. This forward-looking approach requires institutions to develop sophisticated models and methodologies that consider a range of economic scenarios. These scenarios might include factors like economic growth, unemployment rates, interest rate fluctuations, and industry-specific trends. By incorporating these forward-looking estimates, CECL aims to provide a more realistic and timely view of an institution's credit risk exposure. This in turn enables stakeholders to make more informed decisions based on a clearer understanding of the institution's financial health. Another key component of CECL is the concept of lifetime losses. This concept fundamentally changes how financial institutions approach the estimation and recognition of credit losses. Under CECL, which stands for Current Expected Credit Loss, financial institutions must estimate and recognize expected credit losses over the entire life of a loan or financial instrument. This means that from the moment a loan is issued, the institution must consider the potential for loss until the loan is fully repaid or written off. This is a significant departure from the previous incurred loss model, which focused on losses expected within a shorter time frame. The incurred loss model only required institutions to recognize losses when it was probable that a loss had been incurred. In contrast, CECL requires a forward-looking approach, taking into account future economic conditions and borrower behavior. Estimating lifetime losses requires institutions to consider a variety of factors. One of the primary factors is the probability of default, or PD, of the borrower. This involves assessing the likelihood that a borrower will fail to meet their debt obligations over the life of the loan. Another critical factor is the loss given default, or LGD, which is the amount of loss expected if a default occurs. This takes into account the collateral value, recovery rates, and other mitigating factors that could reduce the loss. Additionally, institutions must consider the exposure at default, or EAD, representing the amount of credit exposed to loss at the time of default. This includes the outstanding balance of the loan and any undrawn commitments that could increase the exposure. Calculating lifetime losses involves discounting the expected future cash flows by an appropriate discount rate. This ensures that the time value of money is considered, providing a more accurate assessment of the present value of potential future losses. The discount rate reflects the risk-free rate plus a risk premium, which accounts for the uncertainty and risk associated with the future cash flows. This approach ensures that the time value of money is considered, providing a more accurate assessment of the present value of potential future losses. By incorporating these factors, financial institutions can better prepare for potential losses and maintain a more robust financial position. This forward-looking approach is designed to enhance the stability and resilience of the financial system, ensuring that institutions are better equipped to handle economic downturns and financial stress. In summary, the concept of lifetime losses under CECL represents a significant shift in how financial institutions manage and account for credit risk. By requiring a comprehensive and forward-looking assessment of potential losses, CECL aims to provide a more accurate and timely reflection of credit risk, ultimately contributing to the overall stability and resilience of the financial system. The implementation of CECL has significant implications for financial reporting. This new standard, which stands for Current Expected Credit Loss, fundamentally changes how financial institutions estimate and report credit losses. One of the most notable impacts is the potential increase in allowance for credit losses, or ACL. Under the previous incurred loss model, institutions only recognized losses when they were probable and estimable. However, CECL requires a forward-looking approach, estimating expected losses over the life of a loan. As institutions adopt this forward-looking approach and estimate lifetime losses, their ACL is likely to be higher compared to the previous incurred loss model. This shift means that financial statements will reflect a more conservative and potentially more volatile measure of credit risk. While this might initially appear concerning, it's crucial to remember that CECL promotes greater transparency. By recognizing potential losses earlier, institutions can provide a clearer and more accurate picture of their financial health to stakeholders. By recognizing potential losses earlier, CECL provides stakeholders with a more accurate picture of an institution's financial position. This early recognition helps in identifying potential issues before they become significant problems, allowing for timely interventions and adjustments. This enhanced transparency fosters trust and allows for more informed decision-making. Stakeholders, including investors, regulators, and management, can make better decisions based on a more realistic assessment of credit risk and financial stability. Furthermore, CECL aligns with regulatory expectations. Regulators have long advocated for more proactive risk management practices, and CECL supports this by encouraging institutions to be more vigilant and forward-thinking in their credit risk assessments. Regulators encourage financial institutions to adopt robust risk management practices and maintain adequate capital buffers. CECL's forward-looking approach ensures that institutions are better prepared for potential losses, thereby enhancing their resilience in times of economic stress. CECL supports these objectives by providing a more comprehensive framework for assessing and managing credit risk. This comprehensive approach not only benefits the institutions themselves, but also contributes to the overall stability of the financial system. By ensuring that potential losses are accounted for earlier, CECL helps in maintaining the integrity and reliability of financial reporting, which is crucial for the confidence of all market participants.